a turnaround in the view from Jan Hatzius. Are we going to get a 50 basis point cut in July?
Well, 50 basis points is probably a bit aggressive for just one reason. It might actually shock the market that the Fed knows something that the market doesn't. But the market is priced.
Does it need to get ahead of the market, though?
It's way behind the market. The Fed actually should have cut last night. The Fed should not have hiked in December. So the markets are doing a huge amount of easing for the Fed here. So it gave them a little bit of room not to move yesterday. But they gave a very clear indication that we're in a policy easing cycle. And this is the 16th policy easing cycle since 1951. But the markets are doing what Trump wants, which is rallying very aggressively on this. And we're in an era of very, very strong bond returns. Investors should be very happy.
So you say 50 basis points in July, though, would be too aggressive. Outline why and what the Fed should do instead.
Well, as I said, they should have cut yesterday. 25 basis points just means the easing cycle starts. And the starting point is critical because this is a signal in America, but it's also a signal for the rest of the world. And if we look at just 2019, 20 central banks in emerging market countries have all cut rates. 3 countries have cut rates in advanced economies. Advanced economies are way behind here on cutting rates, and many more advanced economies will have to cut rates during the next 6 months.
OK, so just sticking with the Fed for the moment, though. So they need to get ahead of the curve, right? What about the balance sheet? How should that factor into what they do next as well? Because it's not all about rate cuts.
Yeah, we've had a quantitative tightening phase that's going to be rolled off slightly, and there is significant room to do many easing measures. They're going to initially keep it simple and just use the policy interest rate tool, and depending on how the economic sectors perform, quantitative easing could be switched back on. But initially, they're going to keep the message very, very simple and use the rate structure.
One analyst pointed to a big dovish tail in the dot. So we definitely did see a definitive shift in terms of the FOMC. How do you see that evolving over the next 3 months?
Well, the growth is actually relatively solid. But the most part of the growth is actually the consumption. What's very, very weak is actually the inflation outlook. And inflation expectations could destabilize. And if that takes place, the Fed is going to have to speed up the process and might have to deliver to 50 if we see another severe deterioration in inflation. And this is a major inflation problem for all advanced economies in Europe, in Japan, and in other countries, emerging markets. All of the rate cuts are because inflation has actually significantly declined.
OK, so you actually think there is an economic argument for starting an easing cycle with
Absolutely.
the Fed, not just a question of getting ahead of the markets?
Correct.
Okay.
And the markets sense this. So a large part of the bond rally, we have almost 10% returns in 2019 across global bond markets. So it's been the star asset class. Equities are solid, but they've been relatively volatile. We had a crash in December. We had a crash in the month of May. The bond market basically has rallied almost every single day since the 1st of January. So the bond market has been the place to have maximum investments. And the Fed is just going to have to see how the inflation runs.